As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touchtone telephone. Please note that this conference is being recorded. I will now hand the conference over to Mr. Shailesh Kanani from Asian Market Securities for opening remarks. Thank you, and over to you.
Thanks, Ryan. Hello and good morning, everyone. On behalf of Asian Market Securities, I thank you all for joining into Q1 Financial Year 2027 earnings conference call of Suryoday Small Finance Bank. Today from the management, we have Mr. Bhaskar Babu Ramchandran, MD and CEO, Mr. Kanishka Chaudhary, Chief Financial Officer, Mr. Himadri Das, Investor Relationship Head. So without any further delay, I will hand it over to the call to management for their opening remarks. Over to you, sir.
Thank you, Shailesh. Good morning, everybody. Thank you for joining us for Suryoday Small Finance Bank Limited's Q1 FY27 earnings conference call. On behalf of the entire Suryoday team, I extend my best wishes to all of you and sincerely appreciate your continued support and engagement with our bank. Our financial results and investor presentations are available on the stock exchanges and on our website, and I trust you have had an opportunity to go through them. Taking you through our bank's performance for Q1 FY27, the first quarter of FY27 has been a period of continued progress, with our bank building on the stabilization achieved over the past few quarters while maintaining a disciplined approach towards growth, portfolio quality, and sustainable profitability. The broader microfinance industry has started regaining momentum with improving borrower behavior and gradual recovery in business activity. However, we remain cautious and continue to focus on strengthening collection efficiency and asset quality through enhanced central monitoring, technology-led intervention, and a more efficient operating model with optimized dependency on manpower-intensive processes. At Suryoday, our strategic transition from traditional JLG model towards individual loans, Vikas loans, continues to gain traction. Importantly, our customers are returning to their normal borrowing behavior, reflecting improved confidence and stability within the portfolio. The CGFMU framework continues to provide significant support to balance sheet. With a largely covered inclusive finance portfolio, successful claim settlements, and improved provisioning discipline, the bank has further strengthened its provision coverage ratio backed by 386 crores of CGFMU claims received, thereby enhancing resilience against potential asset quality risks. On the secured retail asset side, we continue to witness healthy momentum across commercial vehicles and mortgages. Our strategy remains focused on calibrated growth in secured lending segments supported by cash flows-based underwriting and deeper customer relationships. We continue to selectively expand our presence in commercial vehicles, including construction equipment financing, while maintaining prudent risk management practices. On our liability side, our focus remains on building a granular and sustainable deposit franchise. Retail deposits continue to be a key area of focus, supported by improving customer engagement, digital acquisition channels, and our expanding product ecosystem. Digital continues to remain a key strategic pillar for our bank. Our investments in technology infrastructure, digital journeys, and data capabilities are helping us improve customer acquisition, enhance operational efficiency, and create scalable banking solutions. Products such as credit line on UPI, secured credit cards, digital MSME loans, and digital deposits are enabling us to engage with customers across their functional life cycle. The pre-qualified customer base created through these digital platforms provide a strong opportunity for future and deeper customer relationships. Now, digital customer base acquired through digital deposits and other digital products stands at approximately 1 million customers having good credit record. Coming now to our performance of Q1 FY27, I'll touch upon only the key highlights, while the detailed financials are available in our investor presentation uploaded on the stock exchanges. Our gross advances stood at rupees 14,376 crores, registering a year-on-year growth of 32.5%. Our deposit base stood at rupees 14,634 crores, reflecting a year-on-year growth of 29.4%. The share of retail deposits stood at 87.3% as of June 2026, supported by both our branch network and our digital sourcing channels. Our CASA ratio stood at 21%, and we continue to focus on granular CASA over the coming quarters. With our inclusive finance portfolio, current bucket collection efficiency stood at 99.2%, and the current bucket collection efficiency of the more recent portfolio continues to remain healthy at 99.4%, reflecting the benefits of our strengthened underwriting and collection framework. On asset quality, our GNPA stood at 6.5% and NNPA at 1.2% as of June 2026. In absolute terms, GNPA stood at rupees 931 crores and NNPA at rupees 170 crores, against which rupees 134 crores is receivable under the CGFMU scheme. Adjusted for this receivable, the GNPA and NNPA stands at 2.9% and 0.3%. Our bank continues to maintain prudent provisioning, and together with the CGFMU receivable, our overall coverage on the stress portfolio remains comfortable. Our digital businesses continue to make encouraging progress through the quarter. Deposits sourced through our digital channel stand at rupees 2,222 crores with an average daily accretion of rupees 6 crores. Credit on UPI customer crossed 9 lakhs, reflecting a seamless onboarding journey through VKYC and higher customer engagement through a product-driven approach. We also continue to strengthen our digital MSME loan with disbursement of rupees 59 crores during the quarter, supporting faster customer acquisition and improved service delivery across our retail franchisee through our branch network. We remain committed to delivering consistent performance across all our key business parameters. Our focus continues to be on sustainable growth, strengthening asset quality, expanding our liability franchise, and enhancing customer experience through responsible banking practices. As we move forward, we remain confident that our strategic initiatives undertaken over the past few years will continue to drive sustainable growth, strengthen our institution for the long term, and create enduring value for all our stakeholders while remaining committed to our mission of financial inclusion. Thank you for your continued support and growth and support. With this, I conclude my opening remarks. I'm happy to take your questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Sukrit D. Patil from Eyesight Fintrade Private Limited. Please go ahead.
Good morning to the team. I have two questions. My first question to Mr. Ramachandran is, beyond the regular outlook, what are the top 2 to 3 execution priorities you are focusing on in the next few quarters? And alongside that, what do you see as the biggest risk in customer demand or competitive pressures? And how are you preparing to manage them while strengthening the company's position in small finance banking? That's my first question. I'll ask the second question after this. Thank you.
Our key focus continues on strengthening the inclusive finance portfolio, which is our backbone and our core focus area. We have moved, as you know, to individual loans, which enables us an opportunity to directly engage with the customer and assess not just their credit needs, but their overall banking needs. The secured assets are focused on commercial vehicle and mortgages, which are having their good traction, and we continue to focus in terms of having a growth rate, probably which will be higher than the inclusive finance growth in this portfolio. Digital channels have worked out pretty well, and it took quite a bit of time and in terms of putting the layers. And as you would see, both our digital deposits on the deposit side and on the other side, credit line on UPI customers, which is small ticket but transacting customers are increasing probably on month-on-month basis by around 5 to 10%. These are the focus areas. We will remain focused on this while testing or innovating on the other product lines. The risks obviously are in terms of, as I said, we continue to be cautious when the microfinance cycle has turned, mainly because of weeding out of the customers who did not have a good track record, either circumstantially or otherwise. It is extremely important that we do not really say take this as a renewal of the cycle and go aggressive. So we'll continue to be prudent on our growth. The competition will be intense, and that is where probably our digital play will be coming to play in creating the customer experience.
Thank you. My second question to Mr. Kanishka is, again, along similar lines, from a financial point of view, what key risks or challenges do you anticipate in the coming quarters, and what specific measures are being taken to manage margins, cash flow, and balance sheet strength, especially in areas like credit risk, borrower repayment cycles, or any regulatory compliance? Thank you.
I think the good part to note is that if you look at our MFI businesses, our slippages have moderated significantly. Our slippages on a monthly basis are less than 20 crores a month. So that's one discipline that we should continue to focus on. The other will be that you may have looked that assets have started growing at a faster pace as compared to the deposits, which is a good sign. So there's a demand for the market in the market for loans. So our focus will be to ensuring that we, build up our deposit engine further, make it grow faster, and continue to tap our refinancing lines as and when required. Couple of things which have improved in this quarter, for example, is that with the improvement in the MFI book, the IBPC market has opened up for us again. We took an IBPC funding at around 5%, a little less than 5%. So we are exploring all the funding options, and with the improvement in the MFI book, the funding options only increase. So those will be the 2-3 focus areas for us for the rest of the 3 quarters.
Thank you and best wishes.
Thank you.
Thank you. We take the next question from the line of Harshit from Robo Capital. Please go ahead.
Thank you for the opportunity. So we generated an other income component of around 147 crores in this quarter, which looks too high. So what is the steady state other income we can assume for FY27 for modeling purpose?
So the other income this time has about 90 odd crores on account of PSL income. I think for the next 2 quarters, you can expect that our PSL income will be around 15 odd crores, 10 to 15 odd crores, right? And Q4 maybe somewhere around 20 odd crores.
Okay. And so what is the credit cost guidance for FY27?
So for this quarter, the credit cost is at 0.8%, and like we had indicated at the start of the year, our guidance is that we will be somewhere between 0.8 to 1%, and we stay by that guidance.
Okay, fine. Thank you.
Yeah.
Thank you. Participants who wish to ask a question, please press star and 1. We take the next question from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir?
Yes, please go ahead.
Yeah, hi, thank you very much for this opportunity, sir. So just wanted to understand and not dwell more on that other income. So PSLC income in this quarter was 90 crores. So your net of PSLC income, the other income was close to about 57 crores, right?
No. My PSL income for this quarter was around 46 crores. We sold 1,600 crores of PSL certificates, right? And which is the reason you see that there is almost 45 crore of uptick in the other income.
Oh, okay. Oh, so your other income was 90 crores plus 46 crores of your
yes,
PSL.
Absolutely. Correct.
Oh, okay.
Yes.
Okay. And that 46 crores you expect to be 15 crores for next 2 quarters and then maybe 20-25 crores in the 4th quarter, right?
Yeah, so somewhere around 15 to 20 for the last quarter. Yeah.
Oh, okay. I got it. And sir, on the cost of fund, can you throw some light? I mean, are we seeing any pressure on cost of fund, and accordingly, how should we look at NIMs for the company?
Yeah, so if you look on a quarter-on-quarter basis, our cost of funds have reduced by around 8 paise. We continue to see a pressure in the rates for fixed deposits. They have not really come down. What we have done as a bank is that we have optimized our rates in the savings account across buckets. So that's the kind of focus that we will have for funding. We will be selective in our bulk deposit mobilization. We'll continue to focus on raising granular SA, and we will continue to focus on raising anywhere between 2.5 year FD money.
Okay.
And like I said, on top of that, with the MFI portfolio quality improving, we will be going in for IBPCs as and where possible.
Okay. So accordingly, what does it mean for NIMs? I mean, you expect cost of fund to remain stable, or you expect it to increase?
You can expect the cost of fund to be at around 7.5% for the rest of the year.
Okay. And what does it mean for NIMs, considering that our secured book will keep on increasing? I mean, we expect the NIMs to be stable at the current level?
Very similar to what we are having at the end of Q1.
Okay. And we maintain the guidance of fourth quarter 1.6% kind of ROA that you have mentioned earlier?
Yeah. There's no change in the guidance from what we had indicated at the start of the year.
Okay. Fair point. I think that would be it from my side. Wish you all the best. Thank you so much.
Thank you.
Thank you. We take the next question from the line of Rahul Kumar from Vaikarya Investment Management. Please go ahead.
Yeah. Sir, is there any one-off in the other expense line item? It has increased 20% quarter actually.
Yeah. So just a clarification on that. So our CLOU business has really picked up in a big way. In this particular quarter, our convenience fee income from the CLOU business has moved to 18 crores for the quarter. And there is a corresponding increase in the CLOU related expenses by around 13 odd crores. And which is the reason you see that there is an uptick in the expenses. Apart from that, there have been some additional expenses in the technology infra, but the main driver is the CLOU related expenses.
Okay. So basically, in according to the growth in this CLOU business, you see a proportionate increase in the other income and other expense as well.
Absolutely correct. Yes, please.
Yeah. Okay. Second point, there's a slide on the yield on non-NPA advances. There seems to have some change in quarter one versus quarter four. Can you just help us understand what has changed this?
Yeah. So if you note, what we have indicated is that the yield has moved from 17.2 to 16.1. So there are two components to that. One is that, the share of IF business has reduced by 4% from 48% to 44%. So that has about a 75 paise impact. And in Q4, we had a better recovery from our MFI assets, leading to higher income recognition as compared to Q1. But on that count, I think as we see it, we will be able to go back to our previous levels in terms of recoveries from IF NPS.
Okay. But going forward, we do expect this level to be stable at the yields to be stable at around these levels.
Yeah, we will be going back to around 17%.
Okay. Understood. Yeah. Thank you.
Thank you. We take the next question from the line of Somil Shah from Paras Investment. Please go ahead.
Hi, team. Congratulations on a very good set of numbers. I wanted to know on the JLG model. So how is it shaping up? So customer behavior, is it improving QOQ? And are we looking to increase our JLG share, or are we moving more towards individual lending only?
I am Senthil here. So I think over a period of last 2-3 years, we have been slowly and consciously moving out of this JLG model and moving into individual loans. To that extent that individual loans contribute around 80% of our monthly onboarding. I think we will continue maintaining that ratio going forward. And probably over a period of next year and a half, we will try and reduce our JLG exposure and move into individual loans.
Okay. So basically, are we still seeing stress in JLG model?
Not exactly, in the sense, markets have improved over a period of last 6 to 8 months. So in that way, I think we expect it to. I don't think any stress is expected in the next 6 months at least in the foreseeable future. We'll have to wait and see.
Okay. And in the previous quarter, I think we received claims worth 385 odd crores. So how much claim are still expecting in the current quarter?
No, so we have a very small cohort left to be claimed in the current financial year. It will be somewhere around 13 to 15 crores. That's one of the oldest and the first cohort that we had. But the large chunk of the claim has now been made in this financial year.
Okay. So you mean for the current year only a small cohort of 15 to 20 crores is left?
Yes, that's about it. Yeah.
Okay. Because if I remember correctly, last quarter you said around 450 odd crores we were going to claim this year, 450 to 470.
Yeah, so that was depending on the time of the claim, right? Whether we made it in Q1 or end of Q2. So we decided to make the claim in Q1 itself because it was a substantial amount. So that would mean that, as of Q1, we make 387 and there's another 15 to 20 odd crores for the oldest cohort.
Okay. And my final question is, I think last quarter we said that the current quarter our ROA should be close to 1.2% and we may gradually increase towards 1.6 by Q4. And current quarter itself we have achieved 1.6% ROA. So can we assume that this 1.6% we can gradually increase towards 1.8 or 9 by Q4?
Well, we need to be cognizant of the fact that we had 40 crores of PSL income, and in the next 2 quarters, we won't have that kind of a PSL opportunities. So, yeah.
Correct. Okay, that's it from my side. Thank you and all the best.
Yeah, thank you.
Thank you. We take the next question from the line of Sonal Minhas from Prescient Capital. Please go ahead.
Hi team, this is Sonal. I hope I'm audible.
Yes, please.
Yes, thanks for taking my question. I was just trying to, string together your numbers on slippage for this quarter, which is 92 CR. And also the corresponding net provision after removing CGFMU. Are we seeing any signs of slowdown in recovery? Because I think similar numbers are also visible in your PAR 3090 and PAR 90 plus. So any subjective guidance on that part that you would like to share?
So at a bank level, if you look at our slippages, we have improved from 106 crores to 92 crores on a quarter-on-quarter basis. And similarly for the MFI business, our slippages have improved from 73 to 53. We have had a couple of slippages in our mortgage business, and which we are working on for resolution through the legal process. The point to note is that in these cases, we are well collateralized. The collaterals are well identified and quite liquid in the market. So we will try to complete the resolution process in the coming quarter.
Okay. So this should come down or normalize in the coming quarter or thereafter, basically.
Yeah, that's what we are working at. Yes, we should be able to bring it down.
Got it. That's it from my side. Thank you.
Yeah.
Thank you. We take the next question from the line of Keshav Karwa from White Pine Investment Management Private Limited. Please go ahead.
Thank you for the opportunity. Wanted to know how are you seeing the collection efficiency trend in your MFI book for July month, and further, are you seeing any stress in any of your geographies?
See, the collection efficiency has been largely stable over the last quarter, and we expect it to be, though there's been a bit of increase in inflation, etc., in the last quarter, for the reasons we are all aware. But I think the collection efficiency is expected to be stable. So I don't see any stress going forward.
We are not certainly seeing 99.9 in the VL portfolio. So to that extent, it may not in a period like this. We may not see anywhere closer to 99.9. We are comfortable in terms of clocking around 99.5, 99.6. I think we are very close to July, as you know, June, the first quarter at a couple of months. Do not really go back to the same levels as Q4. Sadly, we are happy that it is stabilizing at 99.3, 99.5.
Okay, sir. Thank you.
Thank you. We take the next question from the line of Shailesh Kanani from Asian Market Securities. Please go ahead.
Good morning, everyone, and congratulations first of all for the great set of numbers, sir. So my first question is on a steady state basis. What kind of ROE we can deliver, considering the current trends what we have and the portfolio performance? What is the steady state ROE as a bank we are targeting?
Yeah. So, as we had indicated in our guidance at the start of the year, Shailesh, we will be in the range of 1.3 to 1.4, and we continue with that guidance at the end of the first quarter.
So this year, I'm sure first quarter performance has been a little bit positive surprise for not only us, for the whole industry as such. So any uptick on that you think is possible? Any upward bias over there?
Sorry. No, carry on, please.
Shailesh, I think what we are really looking at is that now we have kind of the investments and the process improvements that we did in the last quarter is seeming to be paying off. Our focus in terms of ensuring that what we have is sustained and obviously look forward for marginal but sustainable improvements quarter on quarter. It may not necessarily happen Q2 will be better than Q1 and so on consistently across all parameters, but over a period of time where we end up with around 13 to 14, the clear endeavor is that we can really inch it up by meaningful and sustainable 0.5% to 1% in terms of ROE year on year for the next couple of years, and then learn what it takes to deliver consistent performance.
Fair enough. The second question was wanted to understand in terms of profile and quality, how is the current book different from the past cycles? Like, what are the key changes we have done in terms of underwriting or customer selection just to improve our performance vis-a-vis the in next cycle, vis-a-vis the last cycle?
Shailesh, Suryoday here. So a couple of things we have changed almost 2 years back. This is November 2024 onwards. So besides the standard 2 lenders, 3 lenders filters, we also started focusing on the unsecured loans as a basket and the recency of unsecured loans and the heating factor on unsecured loans and our honest payment behavior. So basically a combination of it, we have fundamentally redone our profiling. So we have categorized customers into A, B, C, D, E, and we focus on A, B, and C. In a good market, we can do more of C and D, but the moment market also gets tougher, then we focus more and more on A and B. So we do an internal segmentation of customers, and it is significantly across. We tested it for 3 different time frames cohorts, and it's holding good. So we should continue to scale on this.
So this profiling will be predominantly for the IA customer, right?
So largely for the micro banking customers, that includes MSME and individual loans.
Okay, fair enough. I'll just say one last question from my side. In terms of growth drivers for secured book, right? We have been growing at a very fast rate over here, and I see there are hardly any branch additions per se. So if you could just throw some light on what are the drivers and how do we see this book going ahead?
We will be adding around closer to 50 branches in this quarter and next quarter. But more important, that not all our products are available in all our present locations. One key thing would be micro mortgages and then expanding even CV to the other branches where we are not present at this point of time. So we have large opportunity in terms of expanding to existing locations and branches in the retail secured products. And we'll be adding 50 primarily in terms of focus in terms of inclusive finance and commercial vehicles. Mortgages will follow generally wherever we already have a setup in terms of expanding the geographical presence. Probably we are present in no more than 20% of our current branches in terms of mortgage business. Intent would be to take it to at least 40 to 41% toward the end of the year.
So is it fair to assume that the secured book will kind of continue the current momentum?
Yes. Also, as we kind of keep saying, considering that our base is not very large and it's not too small as well, with the ability to little higher growth on that continues to be good as we see for the next quite a bit of a few quarters.
Fair enough. Thanks a lot. That's useful and best of luck.
Thank you.
Thank you. We take the next question from the line of Ashlesh or Sanjay from Kotak Securities. Please go ahead.
Hi team, good morning. So a few questions from my side. Firstly, on the CASA deposits, that has grown quite well over the last year at better than 50% YY. Firstly, do you expect this growth to continue here on? Secondly, what is the blended cost of SA deposits and term deposits separately?
Yeah. So, insofar as the growth is concerned, yes, I mean, that is what we are working at. We expect to see a similar kind of growth for these CASA numbers. We will be focusing. We are currently focusing more on SA. Over time, we will also start focusing on our, current account product features and propositions. In terms of, the disaggregated cost, if you look at SA, last quarter our SA had a cost of fund of about 5.7%, which we have been able to, make it and pull it down to 5.5. And insofar our fixed deposit costs are concerned, it is about 8.1%.
Understood, sir. So secondly, as you grow by, let's say, 30-35% as you have guided in FY27, what is the kind of OPEX that you have budgeted for in this year? Versus, I think last year you did a total of...
Yeah. So, I think if you look at our OPEX, the kind of target that we have assumed for ourselves to be in the range of around 67 to 70%. This is full stack cost, including our investments in technology, branch expansion, branch-led personnel, and all of that put together.
Understood. Sir, and just lastly, if you can, on the CLOU business, if you can just confirm the numbers you mentioned, what is the convenience fee income in this quarter and the corresponding expense?
We made around 18 crores of convenience fee income, and our proportionate cost was 13 odd crores.
Okay, this was not the increase in cost QOQ, right? This was the absolute cost.
Absolute numbers, yes.
If you can also share the corresponding numbers last year, is that possible?
See, this is a product which is scaling up month on month. We started only last year. So currently we have around closer to 6 lakh customers who are utilizing it and around 9 to 10 lakh customers who have been approved. Every month probably we are on board around closer to 1.5 to 2 lakh customers. In terms of going to the pipe, assuming that around 70 to 60% gets approved around 1.5 lakhs and around 1 lakh we start placing it. This is a monthly, as of now as we speak, very, very small EMI product. It gets extinguished at the end of the month and the remit starts again. As a continued usage happens, we will have a better visibility. But as of now, since it's scaling up closer to probably 5-10% on a month-on-month basis, what we are really focusing on is in terms of ensuring that we are really kind of doing the business with credit costs which are much lesser than what we are programmed for. They're too small. These are on average around less than 5,000 rupees at this point of time.
Understood. So, and you have any sense about what can be the eventual customer base that you can reach out using this product?
High potential. So as when we started, we obviously didn't think that we will have our capabilities in terms of our customers even may come in, but VKYC becomes an extremely important capability that we'll have to develop. We have been able to kind of scale it at this point of time and look forward to scale it at least for doubling or tripling the capacity. So the potential on this, considering it is small ticket and instantaneous, and it gives us a large base on which we have to build other digital products and even probably now other secured asset products. So we will be comfortable if we are able to at least double the customer count during this financial year. From closer to around 6 lakh users, probably to around 12 lakh users. That will be a conservative number. And also there is a limit to which we can really kind of look at in terms of the scale on a particular single product, even from a risk management, but very comfortable for CRS as well.
Understood. So now that you have kind of built the stack for this product, do you see a potential to also partner with other players in the market for this product?
Of course. So our current partner is Paytm. They'll be expanding their kind of partnerships will be. So that's an understanding, and usually every question asked is that who owns the customer. Actually both own the customer. Customer is owned by, when none of the customers have single relationship, they have a relationship with multi financial service providers. So whoever provides the best of customer experience and product feature for that particular product tends to kind of win. Our partnership with Paytm will continue to grow strong, but we'll also be kind of onboarding a few more partners.
Understood, sir. Very useful. Thank you.
Thank you. Participants who wish to ask a question, please press star and one. We take the next question from the line of Avnish Tiwari from Vaikarya Investment Management. Please go ahead.
Hi. Can you explain this yield on non-NPA advances? It's currently running at about 17.4%, and if you are expecting overall yield, at what level? Is it like a function of non-NPA book significantly reducing or non-paying book significantly reducing and coming to 17? Because you also increase the secured mix, which is a much lower yield. So just help us understand where you see this yield going. Are you taking any pricing action because the cost of funds are tightening? So what is in your mind when you look at this fiscal year?
I will take the first part and then maybe I'll hand over for whether we are taking any price correction. I'll give it to Casey. So on yield, I think our stabilized yield would be in the range of, like Casey was mentioning, would be in the range of 17.2 to 17.5 max kind of a thing. That's our stabilized yield. Even if we go IF share, even if it goes to 45%, which is currently it is. So, stabilized yield on advances would be 17.2 to 17.5%, because our secured asset also, our yield is nearly 12%. So on a mixed basis, 17.2 to 17.5 is the comfortable range. On whether we are considering any price rise, I'll request Casey to take this.
Yeah, at this particular point in time, we don't foresee an immediate, change in pricing across products. We continue to evaluate our pricing across all products, but also especially MFI. Given that, we have moved on to individual loans, we have a single price that is offered across the board. But our customer stratification has increased. So we will keep evaluating, but at this particular point in time in this quarter, we don't quite foresee us changing our price.
And roughly, what is the yield you are getting on individual book, which is on a blended basis currently in terms of either disbursement or outstanding book?
25%.
Book.
On VL, it's around 25.25, so we play in that range. The intent is that how can we really substantially optimize as we go. More in terms of individual customers, should it really operate in the same JLG model of each relationship officer owning only 400, 500. Meaningfully using technology can kind of increase that capacity to probably 600, 700 and probably more. Because closer to 70% of the customers as we see today are making their payment without reaching out to them physically through a phone, it's through other channels like WhatsApp, and they come to the branch or through digital and make the payment before the due date, which is currently for majority of the customers 7th of the month. So that I think is more focused in terms of passing on the increased cost by increasing the yield specifically in the IF portfolio.
Great. Just last two questions. One is, what kind of growth you look at micro banking business, and second, in terms of capital planning, any thoughts you have during the course of this year?
Yeah, so at this particular point in time, our capital adequacy is 20%. We have a tier 2, which will be expiring next year. So we are out in the market evaluating proposals for raising fresh tier 2. We hope all things going well. We hope to close something this quarter. But at this particular point in time, I think in terms of our capital adequacy from where it stands today, we will increase it marginally. But yes, 20 to 22% is where we would ideally want to be given the kind of growth that we are having.
And the growth in micro banking, what level of growth are you expecting? Any plan for tier 1?
So I will put it a little differently. I think in so far as micro banking is concerned, we would like to keep to a 48-52 kind of a mix, right? That is something that we have had for some time, for most of last year, and that's the kind of a mix that we would continue to have.
And on tier 1?
Sure. Tier 1 capital. Tier 1, yes. We have a resolution going into the AGM. We are evaluating at this particular point in time in terms of what would be the right time to raise tier 1. Nothing finalized as of now.
Great. And congratulations for the great results and wish you very best this year.
Thank you. Yeah.
Thank you. We take the next question from the line of Tanay Jain from Centrum Broking. Please go ahead.
Hi, am I audible?
Yes.
Yeah. So, congrats on a good set of numbers. So, actually, most of my questions have been answered. I have one question though. So, your vehicle finance PAR stands at 11.5%. It was 10.1% in the last quarter. It's still relatively elevated. So, could you elaborate something on that stress pockets within the CV portfolio? Are used CV loans exhibiting like a higher delinquency trend versus new CV? Can you throw some light on that?
Yeah. See, we have around 80% of our 75 to 80% of book is in used CV. So as such, the PAR has been slightly elevated, in the last quarter, more because of, the fuel prices increase and also in terms of load availability, due to the crisis in Middle East. I think hopefully, we are past that. So I think this quarter we should be able to settle down. This quarter, and generally in the second quarter, across the country when you have monsoon activated, the PAR is generally slightly elevated. But this being an earning asset, it rolls back probably around September or in that quarter, the third quarter generally it rolls back to the original level. So I don't see much of a concern. And specifically for us, we're not, we focus more on used business, where the ticket sizes are much lower when compared to the new vehicles. So I don't see a great challenge. We've also had a focus, or probably will be improving our focus on the light commercial vehicles and the small commercial vehicles. So in that way, I think we should be able to maintain the PAR at the same level as the previous quarter.
So, Suryoday here, just to add a few things. Over the last 1.5 years, the CV market has been elevated across the industry. However, if we benchmark our 1-year portfolio, 2-year portfolio, 3-year cohort portfolio, we are significantly outperforming the market by 2.5x on the credit quality.
Okay. That's fair. So there's no geographical impact, right? It's mainly the fuel prices and the load availability is what impacting, and which will be normalized in the next quarter or so, right?
Yeah, exactly. We don't have any in that way geographical concentration also in this book. We're spread across south, west, and northern markets. So I think the next quarter it should be back to normalcy. Yeah.
Okay. Fair. Yeah, that's all from myself. Thank you.
Thank you. We take the next question from the line of Deepak Agarwal from Param Capital. Please go ahead.
Yeah, good morning, sir. Congratulations on great set of numbers. Sir, a couple of points. So, one is in terms of, I understand you've given FY27 guidance. Now, one thing what investors will want to see is consistency, right? So our numbers have been volatile in the past. Obviously, the cycles on the MFI side have been steeper. But considering practically the entire MFI portfolio is insured and secured, largely should not see that kind of volatility. So looking in FY28, 29, do you think this time it will be far more stable in terms of the earnings?
Didn't get Deepak.
So what I'm saying is FY27 largely will be closer to 300 crore PAT, and getting into, if I look a little ahead for FY28, 29. So in terms of volatility, assuming whenever the next cycle comes, considering we are practically insured on the entire MFI book, so the volatility should be much lower in this cycle for us, sir, whenever this cycle comes.
Yes, Deepak. I think, in fact, if you look at it, when the going was good, is when we said that, we will cover our portfolio
and obviously we thought that it was a pure insurance, but it has certainly protected the balance sheet and the capital. As we enter into this, we are very clear that one, as Sandhu mentioned, is that close to around 80% of our focus now is on individual loan. Earlier, we had to necessarily get customers through the JLG pipe to graduate them to the individual. Now I think we have our product in terms of new to bank VL, as we call it, NTB VL, has picked up momentum across. Even in the new branches where we are opening up, our focus now starts with NTB VL and VL rather than getting customers to the JLG. This gives a reasonably good view, and now it needs far more discipline than just looking at the customer in terms of the number of lenders they have. What we are really building the engine now is more in terms of, that's where, as you said, we are not really kind of guiding a higher ROE at this point of time. The focus is that whatever we do, can every improvement be sustainable quarter on quarter? I mean, at least on a year-on-year basis rather than having the volatility. The model will ensure, and we're kind of very, very clear in terms of looking at all the execution, not increasing our ticket sizes in VL. It can really be great operating lever both for profit as well as in terms of giving cushions. So we will build, as we kind of said, more one-to-one connect, understanding the customer better, and having executives handle a lot more. And within VL and JLG, it is not one homogeneous. VL, we're trying to categorize at least into 6 or 7 segments and decide in terms of how much ratio can we have in each of those cohorts. If the customer has not borrowed at any point of time, not now, at any point of time, no more than say 1 MFI loan or 2 unsecured loans, and the spouse or herself has got a secured loan, good track record, gold loan, all of those combinations can we really now go to a point where I will have minimum 40% in category A, 30% in category B. They are close to kind of getting there in terms of figuring out. I think this year would be in terms of building it, saying that even in the entire cycle, what we saw is that 75 to 80% of the customers continue to be very good, including in the cycle, it is a 20. So what capabilities can you do rather than in terms of choosing the 80, eliminating, getting this 20% into your book as a larger one? That's the focus. I am fairly confident that we'll be able to not just deliver good numbers, but consistent numbers across all the coming quarters. At least visibility, at least in terms of 4 to 6 quarters.
Great. So also, one question which comes to everybody's mind is, so like historically when we were insuring under the CGTFMU, majority of the industry was not, right? And now many players are talking about taking the insurance the way we have been doing, right? So then one pushback comes is if, say, 30, 40, 50% of the industry starts insuring, and if an event were to happen a couple of years down the line, in terms of getting that claim from the insurer perspective, does that become a challenge? Because then if we are talking about a very large number for them to pay out, right? Last cycle was because nobody or a very few number of players were insuring, and hence the number was much lower. But now even large universal banks have been talking about insuring their entire MFI portfolio or a very large percentage of the portfolio under this scheme. So your thoughts of how should we look at it?
We are not looking at it as a shield for doing business. So we'll have to now, I think, with the recent experience in terms of where anywhere between at least at the industry level, close to around 50,000 crores or 3 lakh crores is in terms of 180 plus. Doesn't really include what our portfolio that has been written off during this period. So if you have to kind of think of a model where in extreme scenario, 2 SD, 3 SD, it's going to be around 12-14% portfolio kind of at risk. Whatever insurance you are taking, it has to be the kind of the last resort. If you have to do it yourself, will the business model able to sustain it during that down cycle of a year and a half? That's the way we are looking at it. We are never looked at it, not going to look at it. That the trade insurance is going to be our license to do business in the manner that in which we kind of gives us relaxed norms. The norms will be far more tighter, and probably the way we are looking at it, maybe the premium we'll pay in the next couple of years maybe even be higher than the claims that we'll make. I think that's the business model we want to do. This we are looking purely as an insurance. I wouldn't really be able to comment in terms of the overall, but the NCGTC as a corporation is very well funded. But what is really expected is that this insurance is for ensuring financial inclusion, not in terms of doing business as we want and taking a cover, is our understanding.
Okay, good. Great. Thank you so much, sir. Thank you.
Thank you. We take the next question from the line of Ankur Kumar from Alpha Capital. Please go ahead.
Hello, sir. Thank you for taking my question and congrats for a good set of numbers. Sir, in terms of insurance, can you tell how much we have claimed and how much we have received and how much are we expecting to receive in the coming quarters?
So, like I indicated, we have made a claim of our biggest cohorts in this financial year. We are likely to make possibly one more claim sometime down the line. That will be of anywhere between 15 to 20 odd crores.
And how much have we received in this quarter, and how much are we likely to receive in the coming quarters, sir?
No, that's what I said. So we received 387 crores, right? We will make a claim of another 15 odd to 20 odd crores, which we will receive. Apart from that additional amount that we will be eligible to claim, not this year, but subsequently will be anywhere between 135 to 150 crores as things stand today.
And all this 387 we have received in this quarter?
Yes.
Got it, sir. And sir, on this PSL extra income, you said 46 we have received in this quarter is extra, and we expect 15 to 20 crore in the coming quarter. So given there is like 25-30 crore reduction in Q2, Q3, which we expect to cover from our normal growth. Am I understanding right, sir?
Yeah, some part of it will be covered. For example, if you look at our MFI paying book, it has grown by about 500 odd crores in one quarter. So we expect that kind of a growth momentum will be maintained by us. There will be some income uptake from our CLOU business as well. It's been growing exponentially. And so far as retail, secured businesses are concerned, they have been growing, anywhere between 30 to 35% on a year-on-year basis. So that will add to the growth momentum as well.
Got it, sir. And sir, in terms of monsoon as well as war-related issues, are we seeing any issues in terms of our borrower mix?
Not really at this point of time. We will continue to be cautious, but as we have kind of well past it, they're seeing it obviously as in the commercial vehicle, a little bit of the impact as Sindhar really mentioned. But other than we are not seeing, and we are not really into those segments which are substantial and directly impacted by these events.
Sure, sir. Thank you and all the best.
Thank you. We take the next question from the line of Vibhor Talreja from Nest Amplifier. Please go ahead.
Hi, thank you, sir. Congratulations for a good set of results, particularly receiving this last 387 crores from CGFMU, which has changed your provision coverage to above 80% and net NPAs are now less than or around 1%. So from a business continuity perspective, I heard you saying that at our base, the growth of 30% is in our control, and now with net NPAs at 1%, even the credit cost should be under our control. So any risk you see to your guidance of 300 crores plus PAT for this financial year?
Risk to the guidance. As of now, no. We are kind of really focused in terms of 75 per quarter is what we are really looking at. Or maybe Q2 we were a little subdued because we said that we had in terms of the PSL income, but as Casey mentioned, the paying book in terms of IF is growing at least 150 crores. Which will really add to it. So balance sustained, we can every quarter be at least marginally better, is what we're looking at. Deposits may look like a challenge, but we're pretty clear that we have taken this early initiative. The retail, pure retail, which is around average of around less than 2 lakhs per customer, to the digital channels across multiple platforms is what gives us a reasonable confidence that we'll be able to do it. Some of the deposits which will roll over will be at a rate probably lower than what they're maturing. So to the direction as Casey guided, intent is to really keep the cost of funds around at the same level, but certainly for Q2 and Q3. So that's one we'll have to really focus on in terms of deposits, not really kind of take it. That's 30% growth, including probably 20% growth to maintain the CASA ratio even at 21%. Will be challenging, and we'll have to really armor ourselves to ensure that.
All the very best, sir. Thank you.
Thank you very much.
Thank you. Ladies and gentlemen, we take that as the last question and conclude the question and answer session. I now hand the conference over to the management for their closing comments.
Thank you very much for your continued support as we really navigated the cycle down. We have been fairly able to focus in terms of what we needed to do to come out of the cycle far successfully and focus in terms of delivering sustained performance across both our physical infrastructure as well as in terms of through our digital infrastructure. We are confident in terms of delivering sustained growth in terms of building a very respectable bank with focus in terms of excellent customer experience. Thank you for your continued support.
Thank you. On behalf of Asian Market Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.
Thank you.